It seems to me that a lot of regulators and politicians used FTX, if they were already biased against crypto, to further their own cause. But as we've been saying here at ARK, if you look at Bitcoin and Ethereum, they did not skip a beat throughout all of this. And this contrast, even the newest member of the SEC is talking about decentralization as being critical, transparency, auditability. And of course, FTX and these centralized, opaque institutions are the ones who actually went down. Don't you think that now, in the face of regional banks going bankrupt and different digital assets soaring, that this is a very loud message?
Cathie Wood, founder of ARK Invest, is known for her bullish stance on Bitcoin, Ethereum, and the entire cryptocurrency market. Recently, she participated in a cryptocurrency panel with other analysts, Yassine El-Mandra and macroeconomist Lyn Alden, to share their updated outlook on the space. During the panel, Cathie addressed the topic of regulation and its impact on the cryptocurrency market. Despite some politicians and regulators trying to further their anti-crypto agenda, Cathie pointed out that Bitcoin and Ethereum remained resilient throughout recent chaos, such as the FTX collapse. She also highlighted that the newest member of the SEC recognizes the importance of decentralization, transparency, and auditability, which is in contrast to centralized institutions like FTX. With regional banks going bankrupt and digital assets becoming more commonplace, the trend towards decentralization sends a loud message that traditional banking is becoming obsolete, boding well for the long-term success of the crypto market. Lyn Alden also shared her belief that the Bitcoin and Ethereum bull run is just getting started, as more people seek true safe haven assets and alternative insurance policies to banks.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I do think that FTX did throw a wrench into the support, because we felt the bipartisan support before that, and maybe before Terra Luna, but especially before FTX, and then there was silence, and maybe now they're all in the back rooms, but they are not out there advocating the way they were. There is silence, and we are moving into an election year, so I just hope you're right, and during the election year that bipartisan spirit comes back on this. But the banks made two major mistakes in their assumptions, and both of them actually are very understandable, because these two assumptions proved wrong, because they had either never happened or never happened in our lifetimes. So one of them was during COVID, as the Fed and everybody else was worried about depression. You look at the Fed's forecast in that year of 2020, they had interest rates short-term interest rates at 0.2 through the end of this year, which is where their forecast ended. So you've got these banks like Silicon Valley and others who say, okay, I'll put my money into government-backed long-term instruments, very safe, maybe too much held to maturity in the case of Silicon Valley Bank, but very safe, right? 1.6, 1.7% yield. And then the Fed raises interest rates 20-fold in 1 year, which has never happened. Never, never, never happened. Volcker was twofold, 10 to 20%. And many people brushed off, our concern about this because, it's such a low base. That's exactly the point. It's been such a low base for so long that nobody expected this. So that was the first mistaken assumption. And even that would have been okay as long as the deposits had kept flowing in, which of course they didn't. We had the venture capital funding drought. That's why Silicon Valley's deposits started departing. And others were just looking for higher yields and money market funds. And if you look at many people think the large banks have been immune from this. They have not. Their deposits are falling as well. And it is because of this search for yield and safety. I mean, the most damning thing I've heard during the past few weeks from a number of people who said, well, yeah, I lowered my risk by taking my deposits out and increased my return by putting them into money market. That's not how this works, lowering your risk and increasing your return. So I think that's how it started. I think the Fed has, has made a lot of mistakes. And I think the reason is it does not respect market signals. Doesn't respect credit default swaps going up, so bets on bankruptcy, doesn't respect inverted yield curves, doesn't respect commodity prices going down. There are a lot, and is the first Fed ever to raise interest rates in a crisis, and now they're thinking about doing it.
Yeah, I think one of the challenges is like if we look at one bank, we get one opinion, but if we look at the banking system as a whole, we get another opinion. So any individual bank could have managed this better than, for example, some of the really problematic banks handled it. They chose long duration, they chose a riskier deposit base, basically very business oriented, very industry specific. They set up two risks on the same balance sheet, which were catastrophic. But when you look at the banking system as a whole, someone has to own those securities, and they have to own them with these funding costs, kind of the way we set up the system as it currently is. And so the sheer level of activism from the Fed is just an extremely hard environment for those banks to operate under. Ironically, if they had shorter duration but higher credit risk instruments, they held up better than if they had long duration risk-free assets in this environment, which is normally not how it works. And back in like late 2021, the Fed, inflation was way above target, and the Fed was still doing QE. They basically were slow to be hawkish, but then when they finally turned hawkish, now suddenly they pull liquidity out of the banking system at a record pace, while to Cathie's point, increasing interest rates at in a year-over-year basis is the highest absolute term since the 70s, but on a percentage basis from such a low base, it's the highest ever. And the banking system's not really designed to be able to withstand that type of turbulence. And if you look at the Federal Reserve itself, it's operating at a loss because part of its way of managing interest rates is it increases the rates on its own liabilities. And as the Federal Reserve, it's able to do that because it doesn't need to be profitable, doesn't need to, it's not exposed to bank runs. But, if you were to just take the average bank now and put their deposit rates where money markets are, they'd almost all be unprofitable, and therefore they'd be losing capital from and they'd be unable to raise capital. And so on one hand, if the Fed's saying, okay, all banks have to do what we did, well, then you destroy the entire banking system. And in the past prior few raising cycles, you saw T-bills go up in rates, you saw money markets go up in rates, and deposit rates didn't really follow because these were pretty brief changes, and eventually those rates would come back down before people really adjusted to those new rates. But if they do try to target a higher for longer environment, and in a world where information flows around faster, the ways of moving money are faster, banks are kind of stuck having to raise their rates to try to keep up with this. And then the end game scenario is if they actually get up to where the Fed is on rates, if they get up to where money markets and T-bills are, they're practically all unprofitable and then heading towards insolvency. So kind of like, I think the Fed is just in some ways not understanding the gravity of the situation, and it's both on the upside and the downside. So they were overly aggressive on things like QE, longer than they needed to do it, and then now they're being super hawkish, and it's like it's just a very actively managed system, more so than it I think needs to be.
And actually what we've seen, I don't know if you have done this with your own accounts personally. I didn't even know how low some of the rates were on some of my accounts, and I said, heck, let me get out of here. So I've contributed to this. They've actually advertised this and exacerbated it.
Yeah, I think now there was a wake-up call. It's like a lot of people were kind of complacent. And I think, when it's considered low risk, they don't really chase, bank deposits have historically been pretty sticky. You don't shop around for a new bank just to get a couple extra basis points here or there. But when people are actually concerned with their risk, suddenly they pay a lot more attention. And when you see that it's to the prior point about both higher yielding and lower risk, if they make certain choices to move, then they do it. And so we're still seeing very rapid inflows to money markets, and so all of that is pressuring the liquidity profiles of banks. And something that Caitlin's pointed out before is that as money moves faster, if anything, banks need more liquidity. But one of the Fed's tools in this environment is they're trying to constrain lending by pulling liquidity out, which is it's just kind of an interesting way of doing things. And I think it's if anything, it shows kind of the downsides of such a manual, old school process of trying to run a financial system.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.